Okay, well, I think we'll get started then. Once again, welcome everyone. My name is Arthur. I'm the risk specialist at Mashir Properties, and I'm also involved with the Qatar regional group of the Institute of Risk Management. So welcome to our webinar this evening. We're going to be looking at the topic of the role of risk management in managing and building financial resilience, which I think is very relevant, particularly at this time, given the challenges that we're all facing. Before we get started, though, I just wanted to bring to everyone's attention that based on these webinars and the previous meetings that we've had before the lockdown, we've produced a couple of papers that have been published by the IRM, one to do with risk management from the perspective of the internal auditor, and another dealing with the role of risk committees. And these were developed based on the discussions that we had in these previous meetings. So thank you all for your contribution to that. And we hope to produce further papers of that nature and contribute to the body of knowledge around risk management. So to that end, we will be recording tonight's session, also so that people can view it later on, but also to assist us with developing some educational literature based on the topics that are discussed. Right, so once again, thank you for joining. We have two speakers tonight who will explore the topic briefly. And then we will open it up to questions and discussions from yourselves and amongst the participants. So in order to keep things simple, if you do have any questions at any point in time, please write them in the chat and we will try and address as many of them as we can. So to get us started, we're very fortunate to have Grant Griffiths with us, who is a global risk and governance advisor with over 30 years of experience in risk and crisis management, as well as strategy and business development. He's the current chairman of the Turkey regional group of the Institute of Risk Management, and he's also the deputy chairman of the Energy Special Interest Group. So extremely qualified to speak on this topic. I personally look forward to seeing what Grant has to share with us. So thank you, Grant. Please go ahead.
Thank you very much, Arthur. If I can just grab the screen there. So if everyone bears with me just for a moment, and we'll make sure that the magic technology works here. But you know, Zoom has become very popular now, and we should probably all be masters of it, given COVID-19 and all these events in the world that are changing the way that we work. But thanks very much for the introduction, Arthur, and thank you to the committee for asking me to give a talk. I've met some of you. I noticed some familiar names here that are on the webinar today, so it's great to see you guys turning up, and and some of us have met from time to time. So right now, resilience is becoming, and risk management certainly are becoming very hot topics. Who would have thought a year ago that we would be in this situation? I didn't, that's for sure. COVID-19 has become the great disruptor. Now, normally, if we're doing a webinar like this, we probably wouldn't be spending so much time talking about current world events. But, you know, I've found any business meeting, any webinar, anything at all, if you're not talking about coronavirus, COVID-19, SARS-CoV-2, whatever term you want to give it, or about highly infectious diseases and pandemics, well, you've obviously been living on a deserted island somewhere with your head in the sand. And believe me, I wish that person could be me. A number of times I thought, wow, you know, the world has just been disrupted on such a massive and unthinkable scale. A lot of people have referred to the COVID-19 pandemic as a crisis. Some people have said it's a black swan, although I think I'm not alone here in expressing the view that most of us as risk managers are saying it's not a black swan. It's in fact a grey rhino. someone dared to venture the other day that it might be a grey swan. I thought that was a great one actually to put in the back pocket and use some other time, a grey swan event. We're yet to see one of those. It is what we might call a wicked problem. Rittel and Weber did some work many years ago on what they termed wicked problems. And that is that every time you try and find a solution to a problem, you uncover more and more problems or stumbling blocks along the way. So COVID-19 is sort of falling into that wicked problems type category. What it has done, it has exposed a lot of weaknesses operationally and especially financially in a number of organizations. And what's exacerbated this? Well, lockdowns and the working from home. I think that's really tested the agility and the readiness and the preparedness of a number of organizations from a business continuity perspective, especially. I think in the past, working from home was something that happened within some organizations. People were relatively well prepared for it, but the sheer scale of it and the ability for the entire organization to adapt has really been tested, and it has exposed quite a lot of weaknesses. I think one important point to note here when we talk about the financial aspects of COVID-19 and its impacts, the near cessation of air travel. And I say the near cessation because I don't know how many of you use that, Flight Radar 24 or similar apps, but I heard a couple of planes going overhead last week, sitting on my balcony here in Istanbul. My wife said, "What are you doing?" So I'm just checking to see where they're going. And when you look at any of these apps, you still see quite a lot of air traffic. Nowhere near as much as usual, but certainly there has been massive disruption, and the losses are running at just over 122 billion US dollars a month for the travel sector. Now that's quite significant. So in the travel sector, what can you really do if you're in the travel sector? There's not a lot, although it will come a little bit later to financial resilience and how you can start to address these things. Supply chains are obviously very high on the agenda. And when we talk about supply chains, people immediately think of PPE and think about medical supplies and what have you. But in just about every industry, we've seen a big move towards just-in-time, keep high inventory turns, keep very streamlined, cost-efficient operations running. But actually, JIT is really being tested at times like this where there is massive disruption. To put it into risk management context, we could say in the supply chain now, we're seeing concentration risk. And I think that's very noticeable on a global scale when we look at the limited sources of supply for quite critical medicines. China's a main source, India's another main source. So there's a real concentration risk there. Or to put it another way, too many eggs in one basket. It's also testing a lot of legacy contractual terms that organizations have, which is constraining their financial capability and their financial agility right now, as well as their operational capacity. And it would be remiss of me if I didn't touch on a subject which is a little sensitive in some parts of the world and for some people, but commodity prices. We've seen some quite interesting things happening, particularly around oil and gas over the last 6 to 8 weeks. And that's been really exacerbated by the COVID-19 situation. So the world is full of what ifs, and what if something had been different, we don't know, but definitely there's a massive oversupply, and that has been exacerbated by a demand shock on the demand side, which has really shifted markets quite dramatically. Even some of the upside industries, so we look at organizations like Zoom and others, there's a massive upside there, you might think, but even organizations like that had their teething problems and challenges. So all the people in the digital world and embracing all the cyber capability, there's still a lead time, there's still a level of unpreparedness, and there's still, in some cases, smaller organizations who have got niche offerings still need to make sure they can tap into the sources of finance they need to actually address the market need and to actually execute on a strategy. And maybe that strategy is something that's been driven by COVID-19, by an unexpected event. As I said, business continuity management and other things have been severely tested as well. So just moving on now, and we'll just talk a little bit about something Hatem sort of asked me at the last minute. I think one of our colleagues wasn't available to talk on it, but the IRM survey, and we're going to come to this a little bit later. Hatem, Martha and Sean, I think, are also going to get quite engaged in the discussion here. But just to give you a high-level summary of the IRM survey that went out globally, there was, I think it was about 960, 970 responses received. And one of the questions was, how satisfied are you as an organisation with your initial response to COVID-19? And that was interesting to see. It was around 82% of enterprises. 86 had an established crisis management group or function set up as a result of COVID-19. And what's very interesting is that number on the bottom, that even out of organisations that, should have known better, probably should have planned for it and should have been thinking about risk, 32% of respondent organisations hadn't considered a pandemic risk prior to COVID-19. So that's very interesting. That actually, as risk managers, I think for us, there's an unintended consequence, or there's a flip side to that, and it's probably a silver lining, that organisations like that will start to think more seriously about risk and about resilience and business continuity, and where we come in as risk managers. Now, here's a very interesting figure, because 1/5 who had considered pandemics proceeded to do nothing about it, right? So that's even better news for risk managers. Mind you, some people out there may well be asking, what were we as risk managers doing and where were we when COVID-19 hit? And that's a debate for another time. But that's just some of the takeaways from the IRM survey on COVID-19. And one more here, the case for risk management is strengthened, and that was a view held by 94% of the respondents. So again, positive news for us in the risk management profession. Arthur, I think, so is it okay if we come back to this after in the discussion? I don't think you want me to dwell any further on the actual survey.
That's up to you, Grant. If you want to spend a couple more minutes on the survey, you're welcome to.
I think I'll push on and we can come back to it in the interest of time. And the current global situation, so just now going back into COVID-19, the situation, so we're seeing a lot of economic stimulus packages happening as a result of COVID-19. So if you look back at those survey results, we look at the level of unpreparedness of organisations. So a lot of them are going to need to do something, and governments, particularly in developed countries, can't just idly stand by while nothing's done. Let's look at the UK. It's a great example of a government that said, okay, we're going, for furloughed employees, we're going to provide support for employees, for employers, and for the self-employed. And I think that's important. And in some cases, stimulus measures are going to be up around 25% of the annual GDP. We're seeing a lot of breaking of fiscal rules. So when countries like the UK and several others had said, look, we're getting our budget in a really great place, we're able to really start investing in longer term infrastructure and national health service and what have you, along comes COVID-19. So if we look at it as businesses, or if we look at it as governments, we're all pretty much in the same boat. I think we're seeing a lot of, for the reason I just stated, the UK, Australia is some good examples, what I'd call almost socialisation of economies, government taking a much greater interest in the financial well-being of the people in those countries. There is one notable divergent story here. Talking to some colleagues of mine in Southeast Asia and other parts of the world, they're saying a lot of the developing countries just don't have any response. From a government perspective, the governments just don't have the funds to support people, let alone small and medium business, who are really suffering. So I think there's going to be a lot of ongoing challenges for financial stability, financial resilience in a lot of the developing countries around the world. So I think that's something to keep an eye on, and I think that's something that's going to play out probably over a 2 to 3 year time horizon. So if you're a business in a developing country, what can you do? Well, your responses are a lot more limited. Certainly the way that people engage and interact, it's a lot different to how we do in Qatar or Saudi Arabia or the United Arab Emirates or Turkey or Southeastern Europe or Western Europe or the US. You know, the access to technology, the take-up rate of technology and the scalability of technology, for example, just isn't there, and nor are the developed supply chains necessary. I was giving a talk about 5 weeks ago to an organisation. They asked me about how does risk management fit in if you have a small business? And we used the example of a coffee shop and said, well, you know, there's a few things you can do. You can just switch your business model and do takeaway, because in a lot of places you can do that. But we're seeing in some countries just a very simple flip such as that to go into survival mode just isn't possible. So the global situation is different in a number of jurisdictions, a number of countries, a number of locations around the world. We're going to see high inflation, I think, as we come out of as we start to recover from the current COVID-19 situation. And there's estimates of around a $9 trillion impact globally. I think the profitability of financial institutions is going to come under the microscope, probably not in the next 12 months, definitely in the next 18 to 24 months. It's interesting because financial institutions have been much better prepared for a shock like this. Because if we cast our minds back 10 or 11 years, 12 years, a global financial crisis, and the steps that regulators took to actually fix that problem and for banks to shore up balance sheets. And risk management has been very much an essential part of the financial stability regime of banks and financial institutions. So stress testing, very strict liquidity ratios and other things. And that's held banks in very good stead. But banks are being called on more and more, as I say, this socialisation of the economies to actually help bail out businesses to an extent, and governments underwriting that to an extent. But this is going to start to fall out when we see an increase in non-performing loans and other things going forward. Banks, as well as business, will have to change a lot of their approaches to modelling and what have you, and I'll come on to that in a moment. And the green movement, I mean, one unintended consequence of this could be that we see things like the green movement, decarbonisation, energy transition starting to come in a whole lot faster. You know, we're starting to see regularly in the news now. This morning, BBC World News, India hasn't had such low levels of air pollution for 4 decades. We're seeing in Venice, people can see to the bottom of the canals in Venice. Cities in China, they've been able to look over to the hills for the first time in years and years. So, you know, the green movement, I think, will start when social distancing relaxes a little bit more. We'll probably see, and with summer coming, people out there waving their banners and doing what they do on the green front, perhaps, as a result of COVID-19 and changes happening there. Now, I'm just going to sort of jump back into IRM surveys here, everyone, if that's okay, because the Energy Special Interest Group also did a survey, and it was concurrent with the COVID-19 survey that the IRM did. And if you look here, we asked the respondents, and again, this was a global survey, to respond back on what they saw as the biggest challenges to their business model. Now, interestingly, there was a number one, a very clear number one was COVID-19, and an equal number two was a global financial crisis and the current situation of oil prices, which are hovering roughly, and I talk about Brent prices here, in a $20 to $30 range as equal number two. And that's $20 to $30 per barrel for Brent. So that's interesting. They had, the energy sector, for example, has had that almost perfect storm of events that I touched on earlier with oversupply and demand shock. Another very interesting point, and it matches in nicely to the IRM's COVID-19 survey. The figures are very similar. We're looking up around 90% of organisations are saying they, and this is energy organisations, will be enhancing or implementing business continuity management and or resilience as a result of COVID-19. So you can see those surveys there, and I know we can say there's lies, damn lies, statistics, surveys and what have you, but actually it's very interesting we're seeing that trend. EY also released some research around a similar time to we did ours, and it actually corresponds just about to within a couple of % of our research as well for energy companies. So just a little bit of a plug there for the IRM and for the regional groups in Qatar and Turkey especially, and for the special interest groups, especially energy and the work we're doing. So yeah. So looking at COVID-19 and outcomes, so what will happen? You know, we spoke about the sort of massive global impact, asset write-down. So the value of a lot of assets businesses hold will be written down. Most reflected in share prices, and we have seen a lot of roller coaster ride in the share prices over the last couple of months, but still a lot of the underlying assets are worth not as much. Certainly we've seen, again, if we look at the oil and gas sector, if we look at upstream, we're seeing things like 50% of rigs being retired or shut down at this point in time. So, you know, what's the asset value of an upstream E&P company? A lot less than it was 6 months ago. We'll see fire sales, I think, which will drive a lot more M&A activity going forward. We'll definitely see consolidation, and I think that will be in areas as diverse as technology, right through to small scale oil producers, right through to other businesses, real estate and others. And I think perhaps a lot more joint ventures, because one thing that's come out of COVID-19 has been, as part of the adaptation agenda, has been this ability to adapt ways of engaging, including collaboration with organisations you wouldn't have thought of collaborating with before. We spoke earlier about supply chain. Perhaps there'll be joint ventures and different methods of approaching a problem there to help share the financial burden and the financial gains to help overcome the challenge of financial instability. Liquidity, there'll be some cheaper money floating around from a while as a result of the stimulus, and that'll be available as kickstarts for startups and smaller businesses. There'll be, I think, if you take a view of a trading-centric organisation, whether you're a bank, whether you're an energy company, whether you're a commodity house, rebalancing of portfolios, there'll be a lot of restructuring of organisations in terms of the people structure, whether that's because they brought more people in and their business has boomed on the back of COVID-19, or whether because they've had to scale back, or whether they just found a better way of aligning the organisation to meet current and future needs. Be restructuring of debt. And that's another thing to look out for. If we look in some sectors where debt rollover, may be imminent in the next year or two, and market prices remain depressed for a while, debt could be quite a major issue. So the race to restructure debt over the next 6, 12, 18 months, 2 years could be a big one and could further push asset prices down. Diversification is an interesting one, because what we found very early on, companies like LVMH was a good example. They announced almost on day one of the lockdowns in France, their perfume production line will be moved over to producing hand sanitizer. It's very well adapted to that. We've seen textile organisations around the world going from making clothes to making PPE. So those sorts of things, I mean, again, they're very quick wins for some organisations because they don't need a real lot of change, and they can actually be the source of generating revenue and creating financial stability and a form of financial resilience in their business model. And risk and crisis communication, as well as risk management and business continuity capabilities, will be more to the fore. And I also think we all know about ESG, environmental, social and governance, and the CEO roundtable on social purpose. I mean, the question is, how might this change going forward? Will there be trade-offs of environmental versus economic growth? I said before, we might see the green agenda getting on its horse again and getting out there and saying, hey, we can decarbonise at a much faster rate. But actually, there might be some trade-offs when business says, no, we need to do certain things to create value again. And I know particularly in some of the emerging developing countries, Africa is a great example, with they're very energy rich. Qatar's another one, a lot of gas there, and generally in the Middle East, a lot of oil and gas. To what extent are countries prepared to trade off that wealth, to focus on an agenda that probably doesn't directly impact them that much. So this is going to be very interesting, because the sources of funding now that traditionally provide financing to business are getting on the ESG, let's say, bandwagon, or the ESG approach to things, and a lot of ethical investing and trying to shy away from investment in fossil fuel organisations. And again, another stat for you, 92% of organisations are putting a greater focus on their operational resilience capabilities. And that was one of the other findings from the IRM Global Survey. So the likely shape of things to come, we've got someone who's not muted there. I'm not sure who it is, but some culprit out there. Don't worry, we did an energy SIG the other week, and one of the speakers had his dog barking mid-presentation, so that was something a bit different. The shape of things to come, we had a bit of a conversation about this a couple of days ago, and we were talking about what will it be like. And I think personal view is, I think there'll be waves. There could even be ripples. I really don't know, but there's a few scenarios here. If we look at GDP there and where it was at the time of COVID-19, we're in a dip at the moment. What will we see? Will we see the V effect? A lot of people, there'll be a V. A lot of people are talking about a W. Some people are talking about a U. Some people are talking about some other shape. You've got the one on the right here, the third scenario there, and I've put a global depression bigger than 1929. That's certainly what a lot of economists and experts who know a heck of a lot more than I ever will, some of them are saying this, and it's certainly not inconceivable. We might actually see a rebound, then a downturn, and it might bump along, and it might go up, and it might come down, and it might ripple. I really don't know. I wouldn't like to bet on it, but I do think we will see over the next 2 years to 3 years, I think, quite a bit of uncertainty and a lot more need for managing resilience, for improving business continuity, and definitely the whole range of risk management capabilities to be deployed and embedded at a much higher level of maturity within organisations, irrespective of industry. And I think a lot of smaller enterprises as well will be looking to understand how they can use risk management as a way of building greater resilience. So business change, I'll just quickly go through this, but again, things like changing consumer behaviour. And a great example of that is how people are shopping. They've moved to online, it's been a necessity. But to what extent will we see people going back to the old way of doing things? I want to go to the supermarket, I want to go to a store, I want to have that human interaction. To what extent will we see people getting back into their cars? It's an interesting one because the demand shock in the oil market, for example, people just aren't using transport as much, and there's not as much public transport, not as much aviation, not as much global shipping happening right now. But to what extent will that return to a normal? It could be that people say, look, there's a very strong case for going to public transport and reducing emissions, but I don't want to take the risk of catching some contagious disease by cramming into public transport until such time as an effective and proven vaccine comes out. And regulations may, of course, impose some changes. I think regulation may potentially play a role in supply chains. As we mentioned before, supply chain restructuring. We may actually see some governments moving to actually mandate that you can or can't source from certain places. Or if you're in a certain industry, then you can have no more than a certain percentage of your supply chain or a key essential line coming from a certain organisation, location, whatever. So that could very much be the case. I think cash flow and P&L reevaluation right now has been something organisations are looking at. They're looking at the business planning cycle. So doing things like a simple SWOT analysis, looking at cash flow in and out, looking at matching your cash flow, looking at restructuring your outgoing payments, looking at your funding, your cash inflow funding. A lot of organisations are moving towards better financial management and development of scenarios. And I know, just giving a plug now to Hatem and I have been working on something here for businesses about how we analyse and how we actually use some proven modelling techniques to model financial situation of a business, different scenarios and what sort of outcomes they have, and come up with an optimal cash flow and a better approach to building financial resilience. Credit management approaches. I put this one in here because I think it's something that's important not only for banks and financial institutions who have always been very good at doing this, but for other businesses. So I think now, looking at, you've got this massive knock-on effect. So the business who says, okay, we thought business would be up here, and businesses maybe it's not as bad as it should be, but a lot of the customers are actually stretching out payment terms. So cash flow is getting strangled. So credit management becomes important, particularly if goods have gone out the door and you're looking at a 7, 14, 30, 60-day payment cycle. A lot of people are getting into 90, 120, 180-day payment cycles because those customers in the supply chain are getting squeezed. They're trying to hang on to cash, or they're waiting for cash. So credit risk management approaches, I think, are going to be, and aligning that with cash flow, are going to become an important focus area. And there'll be a whole range of things. And again, if we look at things like employment contracts and third parties, sure, you need HR, you need lawyers, you need line managers, but we need risk managers also working hand in hand with those functionaries to help them understand the challenges ahead and how they can address those challenges and do it a better way. And so this is just a very quick thing. This is just a more qualitative approach. So a qualitative approach to improving business performance. Yeah, define the problem, alternatives, look at it, look at the information there, reach a conclusion, and document your rationale. So, that's one aspect, but I think quantitative methodologies, particularly around financial modelling, will become a little bit more important. I touched on before financial institutions. Faring better because of the past, but there's going to be limits to their risk absorption capacity, their risk tolerance, I think, and they're going to need to change things in a lot of ways, and they're going to have to avoid something called moral hazard. And this is where risk management and compliance functions within banks are going to have to work very, very hard going forward to make sure that they're not falling foul of that moral obligation to support businesses and others that governments are pushing them towards, but also equally protecting the interests of their shareholders. Because, you know, whether we like it or not, financial institutions, particularly when they're listed companies, do exist to make a profit, and they're entitled to do that, as is any business with a private capital structure. It's entitled to make a return to shareholders. It needs to do it in an ethical way, a sustainable way, but banks do have this added challenge of moral hazard. There could be, I think, future credit squeezes, potentially, as we see the ripple effect and things starting to kick back in, expectedly or unexpectedly. Some consolidation could happen in financial services sectors. And I think, as I mentioned before, ESG and the CEO roundtable and the whole ethical investment landscape, I think there could be a lot more sources of new competition coming in. Actually, we're writing a paper at the moment for the Energy Special Interest Group, and we just touched very briefly on this, on some of the things we might see for energy, for example, where we might see new forms of investors helping to drive decarbonisation and other challenges. So risk management's a forward-looking discipline, as we know, and you know, it's really important that we get a handle of what may lay ahead. And there's a comment, it's always attributed to Mark Twain, but no one's ever really certain if he did say it or not, but history doesn't repeat, but it often rhymes. Or as a colleague of mine used to say, it sure does have a nasty habit of rhyming. So, you know, we need to look at the choices we make today, and we need to take a future view. We may never get it 100% right, but we need to put some foresight into things. And I think as part of financial resilience and stability, we're going to need to look at multiple scenarios, and we're going to have to model those using a combination of qualitative and quantitative tools to come up with, you know, likely outcomes, and then manage the risks around getting there and aligning those with our strategic execution. And so scenario planning, look at a much wider range of possible market conditions. Business continuity is, I think, going to become essential. So there's great work there for the risk management profession to do around business continuity management. And I think because of the ripple effect, it's probably in reality going to be incremental changes. I don't think a big bang is going to be something that most organizations can absorb, not in one hit, or in one hit then executed over 6 or 12 months, because I think there will be ripple effects in other waves. So it's going to be an iterative learning process. There's going to be greater flexibility, and flexibility will be important, okay, even in areas where it's not been thought to be possible before. And again, risk management needs to facilitate these conversations and these discussions and bring to the table different ways of doing things, highlight the challenges, and work with the boards and with the executive teams and with the business line managers to actually come up with ways around problems and different ways of doing things. And so just a few things here, a few thoughts on risk management's role. As I've said, opportunity pursuit for mergers and acquisition, consolidation, diversification, risk has a major role to play there. So, you know, whatever combination of those things comes up, and whenever it comes up, there's certainly a role for risk management. And I spoke a bit before about liquidity. I wanted to just touch on this to illustrate the point about what businesses are facing now. And this is one of the outcomes that I think where financial institutions look at this sort of thing on a regular basis, on a daily basis, a weekly basis. In fact, it's part of the regulatory landscape and part of the regulatory infrastructure that they have, especially in banks, and following the global financial crisis, is liquidity management. And, you know, they look here at, and this process, this approach, this is easily adaptable. This is adaptable into other sectors as well. So you look here, you've got the brownish red coloured bars where we say, okay, here's your cash flow. Yeah, it can be up and down. Sometimes you're going to have negative cash flow, that's fine. But if your cumulative cash flow and your level of funding cash flow is up above the zero line, and covering the peaks, you're pretty much okay. What we call your survival period comes at the point at which your positive liquidity hits a zero mark and crosses that line. We're then beyond survival, and we then have to consider new sources of liquidity. So we need to do something, whether that's bringing forward cash flow, whether it's tapping new sources, whether it's having reserves. And I actually wouldn't rule out the possibility that for a lot of businesses, in some sectors at least, that governments may start to bring in some regulations that reflect those of financial institutions, where they say, well, okay, then you need to look at your liquidity and you need to look at your survival time. You need to actually have access to liquid assets that you can call on in times of crisis. So again, this is something where we start to look at building financial resilience. This is one of the many things that we do, and it's something that that as risk managers we should be doing, and we certainly shall start to do going forward. I can see it, and looking at these options and driving better decision making on a daily basis as well as a strategic basis. And just some of the things, there might be perhaps some different approaches taken to modelling credit. You know, what sort of trading terms will you have with customers? You know, stress testing frameworks, scenario development. So again, there's a whole range of things here that have consulting, probably a little bit of software sitting in there, and a whole range of reports. But the secret is in aligning that and bringing it into reality. Strategic partnerships and other such things will probably play quite an important role. So I've just put up there, I'll make these slides available for everyone, but I think that's really about that. Just a few other things, keep an eye on. This is only my personal views. A faster rise in Chinese hegemony. Will we see it? There's a lot of things going on in the world today. Geopolitical uncertainty. Well, you guys in Qatar, I think you can talk. We've got our own problems here in Turkey, but I think you're on a much broader basis there and closer to a lot of hotspots. Unexpected presidential election result in the USA. Yeah, I'm not calling anything, but yeah, politics is very strange. Let's keep our eye on that one, because that will, depending on what happens, that's going to be interesting. Will we see the fracturing of the EU in the medium to long term? I don't know. Some people say so, some people say not, but I don't know. So thanks everyone, and I will work out how to stop sharing.
Thank you very much, Grant. You've given us a lot to think about there. It's a wonderful depth that you've gone into, and I think one of the things that comes to mind to me as a risk manager is just that there's now so many more things I think that we will have to consider in the longer term, well, and in the short term. It can be quite overwhelming, I think. Fortunately, we don't have to navigate these things alone, and we're very grateful to have Sean Gatora with us, who's going to give us some more perspectives on the topics that you've covered. Many of us enterprise risk practitioners, of course, don't really have much of a background in financial risk management or financial analysis or anything like that. So we thought for today's discussion it would be useful to get the perspective of a financial risk lay person on some of the issues that have been brought up, and the role that we as risk managers need to play in supporting our companies in addressing these challenges. So Sean is the Enterprise Risk and Compliance Manager for the Qatar Petroleum Company, and his expertise is in project and enterprise risk management, mainly in the mining and energy sectors, but we're very fortunate to have his experience with us today. So Sean, please, if you could give us your take on the subject.
Oh, well, thanks, Arthur. Grant, thank you very much. You really went into depth with that topic. For a lot of us, this is very, in depth. Have to get your mind around some of the terminology, etc. However, you really did touch on some really key points. And everyone right now is worried about, financial positions, financial resilience. Is the company going to stay afloat? Like me, there are many people who aren't exactly in the financial know-how or understand in too much detail all this fancy financial talk about hedging, etc. Our job is simply just to make sure whatever strategy the organization takes is the right strategy in order to, ride this wave and continue as an ongoing case as a business. The way I see it is resilience, financial resilience is a result or a consequence of embedded resilience in the organization. Now, you could do that before the crisis or the disaster, or you could do it afterwards, embed it. Now, typically you want to be very proactive about it. So ecological resilience. So proactive, you build it in, you've got your structures in place, you've understood how your business can be flexible enough to handle changes, swings in the markets, etc. And it goes to the point that Grant talked about, about business change. There's going to be a lot of business change happening. Just the swing of oil prices going from 40 or 45 down to 20. About 300 oil companies in the US went bankrupt. Now, why? Were they not set up to be resilient? Did they not anticipate this? In some cases, you find that these companies produce, niche product, single product, and that's what they produce, regardless of what the company is. And what happens is they choose to take on this risk. Now, how do we deal with this uncertainty? How do we deal with this resilience? Now, as a risk manager, the first thing I would advise is, look, let's go back to basics. Let's talk about risk capacity, organizational risk capacity. As a risk manager, you should be going back and looking at what is our current capacity for an organization to absorb risk? What's our current appetite? Now, most of us, our capacity has been shrunk because of the current environmental conditions. The context has changed. So you then want to find out how you're going to bridge the gap between your appetite, the capacity, and your current risk exposure. And you want to understand how you can do that. Then you can use banks, you can use various forms of financing to bridge that gap. If you can't do that, you have to start bringing down your current capacity or reducing your appetite so that you don't take on things that expose the organization to risks. So we start seeing things like companies cutting down projects, slowing down, reorganization, slowing down one business unit so they can focus on a more profitable business unit, balancing the cash flows to understand just to ride the wave. But it begs the question, hasn't this been seen before? And it goes back to what Grant says. Many of us did not think this is going to happen beginning of this year. Many of us did not think this was going to happen last year. Yet 5 years ago, the oil price went down. I think it was 2015, 2016, the oil price went down to 35, and the world went crazy. Financially, we should have prepared for a case like that, in my opinion. At least understood what shape of business can we have to get to that. But oil price isn't the issue here. The issue really is COVID. COVID has changed everything. The context, the environment has changed. Now, to be resilient in this new context, one thing we have to start doing as risk managers is, if you haven't gone through the dip, if you haven't gone through the dip, or you're still expecting the crisis to come and hit you as an organization, and I'm assuming most of us has experienced some form of change from COVID. Now is the time to start doing horizon scanning. Look at every single one of your risks in the organization, all of them, positive and negative. Understand them in the context of COVID. Understand them in the new context, the way we're doing business now. The context has changed. Business is not as usual anymore. You don't have ability to move from point A to point B. The supply chain has been completely disrupted. Suppliers are unable to deliver. So you have to look at all your risks in that space. So it's a good time now to rebase or refresh your entire risk registry to look at it. But don't just look at the negative side. I mean, never let a good crisis go to waste. There's opportunities galore, enough opportunities. Some organizations have made a killing in this current environment. So look at both the negative aspects of it and how you're going to manage it, but also look at the opportunities. As Grant said, Zoom has made a killing in this weird period. Online business, sky high. Delivery companies, sky high. Chanel and all these other perfume companies changed their business to make hand sanitizers. People started making masks. Louis Vuitton was making masks at some point. and they became agile in the context. So they found opportunity in the case, in the context that we're operating. Now, that leads to some form of financial resilience. See, financial resilience doesn't necessarily mean you're still hitting the high profits you're hitting at. You're still making money, or you're keeping the business afloat in some form or shape. We have obligations we have to keep to our society as organizations, to our personnel as organizations, economic partners, and our shareholders. So we have to make sure that as a society, we still have, you know, places for work for people to come. We have to be responsible, morally responsible. So we have to abide to laws. The laws are going to change. As Grant said, if you're in the banking sector, you're going to see changes in laws. I would not be surprised to see a raft of new policy changes or law changes in other organizations, just to make sure that things are there. So keep your mind out for changes in the compliance or the regulatory space. Personnel, obviously we have to look after our personnel. People are the business. Without the people, they're not the business. So at some point, if our people are not resilient in one form or the other, they're not safe, they're not in a good space, the business cannot proceed. This is why organizations have started, you know, remote working, providing healthcare support, psychological support, providing all sorts of kind of things for their employees to get through this process. As long as your employees can do the work, you get organizational resilience, and consequently you get financial resilience. Okay. Our economic partners, we've got contracts that we have in place right now. Some of them we had to cancel because, or renegotiate, or change our partners, our suppliers, or whatever, because of the context or the situation we're in. This is a good time now to look at that, to see, look, is there a way to improve those contracting strategies? Is there a way to diversify, you know, our contracting portfolio such that we're not exposed anymore, and it's a win-win for both supplier and the business. As a business, we don't operate as an island. We've got an entire value chain we support. So if the supplier is resilient, or we can provide the supplier uptake of this product, consequently, we could be financially resilient as well, or operationally resilient, leading to financial resilience. So it's not just thinking of the organization alone. You have to look at the entire value chain from start to finish, a cradle to grave approach, cradle to grave approach. Then shareholders. This is where, you know, the big ticket. Shareholders want their dividends. This is the way of life. Give to Caesar what belongs to Caesar. This is the time where organizations need to have serious discussions with shareholders to see, look, do we have to pay off dividends now? Do we have to, can we, you know, change the business model, change the business shape to suit the current context we're in? Now, whether that's possible or not depends on what kind of business you're in. Cash-rich companies, shareholders are likely to say, look, go ahead, not a problem. Organizations that are really on margins business, it's kind of difficult to delay, you know, paying dividends or delaying satisfying shareholders, because they have obligations from banks, you know, from lenders, etc., that they have to meet. So there's a balance that has to be struck in terms of discussing with shareholders. So for me, those are the kind of 4 major areas you need to look at. You know, your society, regulatory frameworks, your personnel, your people, very important because they are the business, your economic partners all throughout the value chain, and the shareholders. Now, is it possible? Is it possible that there could be a different way we look at business in the future to ensure resilience? I believe so. I believe that there are a lot of learnings we could have picked up from. I think we've had so many disasters worldwide over the last 10 years that it's, by this time we should have learned something. We've had the Fukushimas, the Deepwater Horizons, we've had everything. It's a myriad of disasters we've had, but for some reason, companies are very reluctant to embed resilience, operational resilience. We are quick to come in after the fact in a reactive kind of way to try and implement financial resilience, organizational resilience. We really need to be able to be fluid, you know, like dampeners in a car, like, you know, suspension. You hit a bump, you know, you're smooth. It seems like we're driving tractors without shock absorbers, you know. You hit a bump and everything is chaos. Now, how would that look? How would that new type of thinking look like? Foolproofing a business to ensure operational resilience. Now, organizations, large organizations, will find it hard to find a single form that, in the worst case scenario, absolutely worst case, a meteor strikes the planet or something, we can continue as a business. That's far-fetched, but it can happen, right? How have companies that have been through this done? Nokia is a good example. Failed, no resilience, no operational resilience, completely out of the game. There was no pandemic, there was no COVID, there was nothing. It was just purely no operational resilience, poor strategy, no risk to strategy, result out of business. Now, do we want to end up in that space? Look at strategy, talk to your organizations, get involved and ask the right questions. Are the decisions you're making, are they good for short term? Are they good for medium term? And how do they look like in the long term? And it goes back to the modeling that Grant was talking about. Get your finance guys involved and start looking at, you know, your models, your financial models, short-term models. Do some quants if you can, statistical modeling if you can, scenarios around about what could happen, especially in the long term, because COVID seems to be, you know, going to last at least. I'm not a specialist in the space, but it could last a good, you know, year or 2 years, 3 years, who knows. But when you do your models, and as Grant was talking about GDPs and the double dip and the scenarios that he was talking about, and the other risks that could come into place, there are non-related risks that could happen. We could lose, you know, power completely in the country. And have we thought of that? We could have a massive coronal mass ejection from the sun, total economic blackout, whole world blackout. What do we do then? There are so many unrelated risks that have got nothing to do with COVID that we have to start thinking of. So right now, blank slate. Once you finish reviewing your risk registers, you need, or the risks to your organizations, both internally and externally, start afresh. Start brainstorming. What are the things that you haven't thought of that you thought couldn't happen that could contribute to this? This is just the beginning of the things that could happen. A war is likely. Grant talked about the global geopolitical situation regionally. It might subside because normally when there's a good crisis, people tend to huddle together and, you know, and they could find a solution. Or there could be an opportunist that might want to disrupt it even further. There's so many various scenarios or options that are to play. So take your time to create scenarios, take the time to look at various short-term, medium, and long-term cases that could come into play. Change. Let me talk a bit about change. Change is happening. And at the speed at which change is occurring, we seem, or organizations or risk managers may or may not be fully participatory in the change process. And it's critically important that we dot our I's and cross our T's and make sure whatever change is occurring is sustainable, has been managed correctly, and the risks associated to that change are understood. We're operating on Zoom, organizations are operating on Zoom. The IT risks associated with that, how are they looking? Companies could be completely wiped out because of cybersecurity. There's a cybersecurity aspect that's got to do with operational resilience, which could ultimately impact your financial resilience. So all these things are interconnected. And I'm always talking about deal with your operational resilience first. Deal with your day-to-day business. Be able to continue business in the worst conditions, in the optimum conditions, in the best conditions. And always have room or the agility to take opportunities when the time comes. Purse strings are tight right now. Companies are holding back finances, you know, postponing projects, canceling. You know, that golden nugget could be out there. That opportunity in your organization could be out there that could change the whole business around and make a lot of money or make you extremely profitable. So look out for those kind of things. Remain agile. Don't just think that this is just an absolutely negative scenario. Organizations are going to hunker down. They're going to reassess their strategies, participate in that process, because this is the only, I think, it's a once in a lifetime event. I think I was having a chat to one of my colleagues and saying, this is the most exciting period for risk managers and business continuity managers. So once in a lifetime event, we'll never have an opportunity, to tinker around with our, theories and tinker around with our, quantification models. Never will we get this opportunity. So if you have the capacity to do quants, please go ahead, go out quants. Understand your value at risk. Take the time to hire an expert. Call a friend, as we would call it. Call a friend. I have a good friend who I call once in a while across the ditch. The next company, to say, look, I need some help here. If you're not in that space, qualitative is just as good. It at least gets you within the ballpark. It gets you within the ballpark to understand what could hurt you. So use your risk matrix. Understand what you can do and leverage your partners. We are not all finance gurus. Grant is the specialist finance guru between the three of us here, or the four of us here. So leverage your friends. I'll always give Grant or call, or Arthur a call and say, look, let's have a chat. Now, projects. Sorry, I have a lot on my mind here. I've been steaming to talk about this. When it comes to projects, and a lot of our projects literally have been, canned. Whether it's construction, whether it's, up in the oil and gas business, doesn't matter. A lot of projects have been canned. At the same time, with the cheap money that Grant was talking about, banks lending money, etc. What you find is there's going to be I'm expecting a boom in construction, and all these projects are going to start looking at that. So your funding options, especially when it comes to the financial part of project risk or cost risk management and projects, your funding options, the way you structure your funding is going to be super important. How you leverage your debt ratios in your projects is very, very important going forward. So yeah, keep that in mind. And that's pretty much my 2 cents on the matter on the resilience. First of all, get operational resilience right. You cannot talk about financial resilience without talking about operational resilience. Financial resilience, for me, is an afterthought after something happens. If you get your operational resilience right, in whatever context, good, worst case, and the best situation, you should have some form of financial resilience. That's my little 2 cents on the matter. As a financial.
Thank you very much, Sean. Something that's sort of becoming very clear to me based on the things that both of you have said is that it's never been more important that risk and strategy work hand in hand and that they are linked. A lot of the things that you've both brought up to build financial resilience and to build operational resilience, these are big strategic decisions that companies are going to be making. Do we change our business model? Do we switch to another market? Do we change our product spread? All of these are big strategic decisions. The reality is, at least in my experience, that risk is not always close enough to the strategic decision-making process to have the impact on these decisions that, well, certainly we as risk managers believe it should have. So my question, I think, to both of you would be, what can we do to support our businesses and the decision makers in our business to make these, to make the best decisions, to make the best risk assessed decisions, given that, they're not all, hopefully as a result of the situation, they might be more opening to listening to the things that the risk managers have to say, but that's not always the case. So you guys have touched on things like scenario planning and modeling and this sort of thing, but perhaps you could go into a bit more detail on, what does this support look like, especially if we're having to, as is the case, I think, for many of us, largely work on the periphery of the strategy process. So what's the best way, in your opinion, that we can support that? So maybe let's start with Grant, and then we'll come back to you, Sean.
Yeah, thanks, Arthur. Yeah, so I think one of the things is to help, where we talk about scenarios, we talk about a lot of the forward planning, the SWOT analysis, and things like budgeting, planning, forecasting. You're trying to push a lot of that, and sometimes you need to take a step or two back. We need to go take a walk down memory lane and probably go and look at what the forecast was for this year and the business planning cycle was for this current year we're in, and then come up with a real world view of where we are now and take it to management and say, this is what we thought, this is where we are, this is reality, but what didn't we do? And get that conversation going around, well, we didn't consider the options and what could happen. So, okay, going forward, here's an approach, right? So we need to have that conversation about scenario planning and strategy and planning and forecasting, looking at different scenarios and different factors in there. And again, with a lot of talk around perhaps, cheaper money being available, changing supply chains, that type of thing. Let's start to explore alternatives. And it's not something, by the way, that we as risk managers can do on our own, but we need procurement, we need legal, we need HR, we need finance, we need so on and so forth, as well as the actual operational business lines to be engaged in that planning, in that brainstorming, and in developing approaches where we can explore options and we can look at how we can change things and build resilience in the organisation. And I think you've also got to look for some disasters as well, quite frankly, to be honest. You've got to find some really bad things that have happened, even if they were 10 years ago. Yeah, and you've got to say, look, we didn't think a global pandemic of this nature would happen. Likewise, 10 years ago, we didn't think this would happen. By the way, have we ever revisited this? Oh, no. Could this happen again? Let's not fall into the same trap. I think it comes down to a little bit of salesmanship, to be really honest. I think you've got it. There's an old saying in sales, you've got to sufficiently disturb people, or these days I like to call it a call to action. But you really need to, particularly when you're talking to boards and senior execs, you've got to get them to the point where they're not going to sleep so well at night about one or two little things. I know, it's easy to say, but I've been fortunate. I mean, I've done a couple of projects around the place with Alex Larson and with a few other people and with other organisations. And I think in those, we've been pretty lucky because we sort of always come in with a mandate and organisations that want to do things with us because they can see the value. Going back many years ago, I've been in that situation where it had to be sold. And that, look, it is a really hard sell, but you've just got to work at it. But I think there is much greater awareness now. We've just got to leverage that, to use your word, Sean. You've got to leverage what's there. And I think you've got to leverage the current situation to drive risk management.
Thank you, Grant. That makes a lot of sense. Do you want to add anything to that, Sean?
Yeah. Grant mentioning you have to sell it. At the same time, I think we find most of us have got our own back channels. We all have our back channels of communication to the executive, to the board. This is the time when your back channels are extremely, extremely useful. Why? Because these are the immediate person that you're going to influence. Unlike a pandemic, you influence one person, he understands the problem, he can influence the next person, and it builds up enough head of steam that a change can be made. Secondly, if you haven't already, or you're not part of the team, or you haven't looked at, reviewing your objectives for the year or for the next, 5 years, this is the time to start doing that. Relooking at those objectives, which a lot of those objectives aren't going to be met, could ultimately result in questions being raised about the decisions around strategy. So an easy in would be to first of all start looking at, look, what are our objectives? What do we plan to achieve? What do we plan to do? Can we still do this? Yes or no? The next question would be, okay, what then do we do? What else can we do? And then you start going to the strategic, decision making, or at least the strategic questioning. or questioning the strategy around that space. So look at objectives, review, or at least start triggering a question around, let's review our strategy. Let's risk our current strategy in the context, which is why it's important. The context we set a lot of our objectives and strategies at the beginning of the year, or late last year actually, has changed. The context is completely different. So I'll take it back to first principles again. Our risk capacity has definitely come down. Our appetite has definitely come down in most organizations. So at least if you follow that chain of thought and you say, look, let's look at this. What can we do? This thing that was green 3 weeks ago, or a month ago in terms of our risk profile, low risk, we can do it. It's not that anymore. It's now extremely red because of 1, 2, 3. So that would be the starting point to get to. Communication is key. Most of us are bogged down, and it could be business continuity, it could be crisis management, it could be firefighting day to day. Don't forget your core. Don't forget your core business, which is around doing what you're supposed to do, operational risk, and dealing with that, and making sure that that's happening. Then make sure your communication is up to a level where risk becomes a buzzword. Everyone is talking about, have you thought of the risk? So you need to start talking to people, day in, day out, as much as possible, and the right people. Leverage relationships, as we had said earlier. So that's my contribution to that.
Thank you. You spoke a bit about risk appetite, and to paraphrase one of the questions in the chat, is there a risk that the risk appetites of companies and boards and strategic decision makers is going to be so adversely affected that the question that came up in chat, will risk appetites be so low that the fabric of society is permanently affected? But I think to relate that more to the role of the risk manager, is there a risk that we, as you mentioned, Grant, we need to scare decision makers a little bit, but is there a risk that we scare them too much to the point where it adversely affects the business in terms of its risk taking? Because as we all know, we need to take risks in order to make money. So either one of you, if you'd like to chime in on that.
And this is when the cost benefit analysis of risk comes into play. To answer the question in the chat, yes. Point blank, yes. Our risk appetite in a lot of nations literally went down to zero. That's why people stayed at home. That's why people are told, stay at home, don't go out, don't meet anyone, don't do anything. So risk appetite literally went to zero. Okay, in the organizational context, a lot of our appetites have come down significantly. And you can no longer afford, to take on that project that, was going to cost you, 100 million or whatever the money, because you need the cash now because your cash flow is low. So these are the tactics you have to look at, or the things you have to look at in order to scare. And I don't like using the word to scare, but in order to make it abundantly apparent that we're no longer in a position where you can freely give out money left, right, and center. We've been exposed. We're not comfortable right now. We need to hunker down. We need to kind of, tighten the buttons a bit. Then we start looking at, is there something else we can do? Can I get out my house? Can I go for a walk safely? What can I do? Can I wear a mask? Do I have to wear gloves while I go on a jog or something like that? Then you start building up some form of plan to get into a place where your appetite starts getting wider. Soon we'll all be going to work with masks and gloves on and possibly hazmat suits. Who knows? But at that point, we've had sufficient protection or sufficient risk mitigations that our appetite can increase with time. Now, if we don't do that, if we don't start, looking at appetite and reducing that appetite forcefully in organizations, it's going to be hard to then sell that once people are exposed, and then people get sick and people get exposed now. And I'm talking about people getting sick, but it's an analogy for organizations. Organizations don't do well, and then you start hemorrhaging. You have to start making difficult decisions, organizational changes, etc., etc., etc. So you really have to look at appetite first, forcefully bring it down, or at least talk to your organizations to at least reduce it, and then go forward.
And I think one of the things is, the big question is strategically, to the top brass, do you still want to be in business in 1 year, 5 years, 10 years? And, oh yeah, of course we do. Do you want to be making money? Yes. Okay, risk is inherent in what we do, but we're risk managers and we're forward thinking and forward looking. So let's get ahead of it. How are we going to get ahead of it? Well, there's some tools and methods and approaches. Let's not dwell too much on the jargon, but amongst risk managers now, there's key risk indicators, there's enhanced reporting, and there's training and enabling and developing a risk-based culture so that people are aware of what they're doing and, how to go about it, and they're aware of what decisions they can make, whether it's in terms of a qualitative decision or a quantitative one, that are going to drive the organization forward and get it to a point, and I'll be very blunt here, to a point of profitability and success. So I think it's a really big cultural thing, but there is a lot of heavy lifting, but gosh, with good risk managers, right, it's just implement these things. We're going to help you. That's what the risk function is here for, to put these things in place and show you how to measure. And so, for example, Sean, you said, looking at, as you slowly build it up, as part of that, obviously, key risk indicators is a good one to see what's happening. Do we see that, down the road there's an increase in reports of COVID-19 cases? Yes. Could it happen to us? What steps are we taking? Whether it's a pending financial crisis, what are we seeing in terms of some of the metrics, failures, non-performing loans of banks, whatever it is that's reflecting that. And again, with the review of supply chains and things, we're then going to start to look at, oh heck, how exposed are we in our supply chain? Either on the supply side or on the demand side. What could potentially happen there? So this is where I spoke about rethinking that whole supply chain and third party. A big part of that's a two-way thing as well. And so there'll be a lot of work that needs to be done around that. That in itself is going to also help to enhance the risk appetite and raise the risk appetite again. Why? Because we're going to put a level of governance over our business partners in the supply and even on the client ecosystem side of things. That'll help as well.
And that interdependency of supply chain is actually, a lot more exacerbated now than it was 10, 15 years ago. We are so dependent on the entire value chain, the supply chain, everyone. Everyone is so linked that if one person coughs, there's a ripple effect across. And I think there was a mindset to consolidate all your suppliers from one area. And I think there's going to be a change to look, we need to, what's decentralize our supply chain, or, at least spread that out. So there's going to be a shift in the way people think. But and there's a statement you said, risks. You said risks, something about decisions, risks and decisions. And for me, it's about the risks that could happen as a result of the decision, or the consequences of the decisions people take. So we may not be able to understand, what's happening before the decision is taken, but at least we can paint a picture of, if you do take this decision, these are the range of outcomes. And that's the real, key point where your modeling comes into place, or at least your, scenario planning comes into place, where you can say, look, whatever you decide, your call. We don't make calls as risk managers. We just advise and tell you, look, here's your decision. Here's your, range of outcomes. You choose.
You guys, I think, have touched on this already, but just to make sure we're addressing as many of the questions as we can. I mean, Dylan had a question about how do we achieve that balance between the need for optimization and efficiency versus resilience. So, and really, is that something that, I'm adding this to the question, is that something that the risk managers should be involved in? Finding that balance.
Absolutely, yeah. I mean, even if let's look at a very high level strategic one, reputation risk. if you've got someone in your organization or someone associated with your organization that does anything wrong, what's Warren Buffett say? 20 years or a lifetime to build a reputation and 20 seconds to destroy it, whatever the saying is, let's use that as a good example. With good risk management, you can respond to that, or even better still, you can avoid it because you can see the signs coming. Disgruntled employee, whistleblowing because of poor cultural behavior, or avoiding a deep water horizon, again, whatever it is. There's elements of that, but that also percolates right through the whole supply chain, the whole sort of the industries even. This comes through. So you've got to really, I think going forward, people will be much more aware of balancing this, and risk management has a very major role to play in that, in my opinion. But my opinion, I support Australia in the rugby, but I had to get that in.
Try not to hold that against you, but
yeah, no, look, we forgive you. We forgive you. It's okay. Either you coach, it's fine. Anyway, back to Dylan's question. Look, optimization and efficiency and resilience, in some cases, very few cases, could mean the same thing. However, normally when we talk about optimization, the parameters are so narrow that fluctuations or burps in the system require re-optimization again in the new context. So whether or not you're optimized to withstand the full range of consequences or the full range of of the sine curve up and down the dips, I don't know. How do you balance that? It's a tricky one. For me, it's if you have inbuilt resilience, and the way I view it is, if you have some form of a shape of an organization, or a shape of way of doing the thing, or a shape of a process that is at its core the simplest and the most efficient way to do things, somehow you have some inbuilt resilience. However, there's so many other variables in play that your channel for optimization and efficiency in the business world is so narrow that we can't deal with the outliers that occur, like COVID. Very few organizations were very optimized and very efficient in what they did, but the bounds of that optimization were so thin. So I would think you'd have to first of all expand the bounds for the optimization, and then see what that looks like. And then start thinking, look, maybe we have to optimize in the upper band, and we have to have optimization in the lower band, and look at it that way.
I think the motivation behind the question is driven by the fact that optimization is not necessarily, resilience is not necessarily free. It costs us money to prepare for a wider range of eventualities. So, I think there's a challenge that a lot of companies face in determining where is the right level. And clearly, up till now, perhaps that level has not been in the right place. So I think, as you say, a lot of companies will have to reevaluate where they're putting that yardstick.
Yardstick to say the band is so much, we can be resilient in this bandwidth, or the target is so thin, we can be optimal in this narrow bandwidth. So there is a cost. There's a cost. Do you want to invest that cost upfront, which is cheaper normally, or you want to do it later as an add-on, which is typically more expensive? So the question is, right now we're all doing it as an add-on afterwards. I mean, a lot of companies rush to buy computers because it's work at home, rush to get IT, and the prices were sky high. Had some form of semblance to say, look, these are our core processes. People actually don't need computers. We can operate the business with our basic processes with these 10 people. Everyone else, and our core businesses or processes for a limited amount of time, then yes. But it's all about, when do you want to spend the money? You're going to have to spend the money one way or the other.
That's a good point on the businesses, on computers you made, Sean. Very simple example there, right? So did they need to do that? You know what? If they had really good cyber risk under control, very strong IT policies, management policies, okay, people, who's got a computer at home, you can use it. There's a few things, a few tools you need, as long as you align with this, yeah, or all that. But for the very first, the first few weeks until we get a better view on what's happening, hey, go and use your own, like bring your own device to work, which a lot of tech firms have those sorts of policies in place. But if you can sort of deploy very agilely on that basis. You also made a comment when you were talking earlier on, Sean, in your talk about, joint ventures and partnerships and structuring the way you set that up. You can optimize within that and you share that vision, right? Risk and reward, sharing the risk and the reward there in the supply chains, right? And in the third party relationships and everything else. And you can optimize within that to a certain extent. And I know if I go back to my Siemens and Alstom days, we're in big, engineering, manufacturing and construction, a little bit harder, but there are ways of doing it and getting some more agility into the process that don't necessarily add cost.
Yeah.
But you do have to sort of, build some resilience in there as well. And just like to remind people that the really strict definition of resilience, and it's, I learned it from some psychologist friends, that it's overcoming adversity. So, can you overcome an adverse situation and get back to where you were or where you need to be?
And I think a lot of people underestimate the advantage of just having thought about something, not necessarily doing anything about it, but at least having thought about it, which is free. Just costs you some time.
Time and money.
Yeah, sorry, I just want to make sure we get to as many of the questions as we can. So I'm going to move it along. We had another question around what is the relationship between strategic foresight and risk management? Would either of you like to have a go at that?
They both involve rolling dices and crystal balls. Is that right, Sean?
100%. Same. It's 100%. It's all the same thing to me. In my opinion, it's imagining what could happen in the future, and it's the same thing.
Yeah. But I think on a serious note, risk management's just about really, again, just putting sometimes a few simple steps in place, isn't it? And communicating that and putting some consistency there and some awareness. It can be as simple as that.
Oh, it goes back to our constant debate with other people. What comes first, strategy or risk?
Sorry, I'm talking with my mic muted, but we had another question around what is the role that governments can play in getting companies to strategically manage risk? Or to expand the question, to properly evaluate how they can build financial and operational resilience into their companies.
Wow, that's always a curly one, isn't it? I mean, if you're a listed company in the UK, for example, we use that because the UK regulations aren't bad and they do mention risk and going concern and all that sort of thing. So yeah, there's quite good things if you're a listed company or a very large company over a certain turnover volume. It then comes down to a question of good governance, and it comes down to a question of quality of timely, accurate information. Because it's only as good, and I've seen some cases where the governance has been very poor, the culture's been shocking, and large bit. I mean, look at the failures last year in the UK, and it was a couple of years ago. Carillion failed in the UK, so there were some failings there by companies that shouldn't have, that just didn't follow the rules. You'll never get over that. I'm a great believer in custodial sentences for directors who do wrong things, right? I don't have a problem, because if I screw up and I'm on a board and if I've made a bad decision in bad faith, right? Yes, I should suffer the consequences, because I have risked shareholders' money, the livelihoods of the employees, and what have you. If I've done it in good faith and it's been an accident, yeah, stuff happens. But yeah, I think for bad faith, I think government should crack down on poor behaviour by directors. That's a good start.
Ditto. My sentiments exactly. For organizations, listed large organizations, there's mandatory regulations and mandatory governance structures that governments can set up for that. For private organizations, however, this is a different story altogether. How does government put its fingers in private organizations. This is where the question, comes into play. And that's where your issue about your, sentencing for directors, etc., comes into play. Possibly that's where it's more applicable. But should we, if organizations are going to, we expect organizations to have good governance. That's the expectation. This is why they've got the structures in place, the board of directors, the compliance people, the risk managers, CRCO. That's their role, to make sure that these decisions at least are checked. There's a check and balance. I don't know, to be honest. It's a tough one. Look, I like governments helping. At the same time, yeah, it's a tricky one for private organization. Me and my coffee shop, I don't want the government getting involved in that. Why?
Well, it's a related question, and I think probably a little bit beyond the scope of the seminar, but perhaps we could look at it anyway, which is that is the government perhaps encouraging bad corporate behavior and bad risk management by bailing out companies that are not as resilient as perhaps they should have been?
A unanimous yes.
Yeah, I'm still young enough to remember something in Australia called the State Bank of Victoria many, many decades ago, right? And that was a classic example of governments picking winners. Winners, not like winners that went the wrong way on the balance sheet.
Yeah.
Look, if we're going to bail out people, I invested some in Bitcoin the other day, or some cryptocurrency. It went down. The government must bail me out. If I make a bad decision, why on earth, as an individual, as an entity, should I be bailed out? Look, it's a tough one. However, large corporations, in my opinion, especially private corporations, should not be bailed out. They've been taking dividends for years. And maybe it's time to relook at the animal, have new organizations coming in. It also brings competition. Let's call it survival of the fittest. Natural selection. But if the government gets involved, that's a zookeeper coming in to look at, to look after animals in the jungle to make sure they survive. I don't think it works, personally.
Yeah. Governments need to put regulatory and legislative frameworks in there. That's it. People need to stick to the rules. Otherwise, what do? You're going to have police accompanying every person so no one assaults someone walking up a street. Where do you draw a line at controlling things? That's in risk management terms, that's too many controls and too much cost, right? So, yeah.
Not naming, an airline who was flying to Australia recently closed shop simply because, they didn't get a bailout.
Yeah.
Well,
Hatem has added another question, which is that, should this apply to small businesses or new businesses who may not have had time to develop the resilience to withstand poor decisions or external events? So
that's a fair question. There's a view on that as well. If they're businesses and they can show a viable business plan, right, maybe there should be some small business government support schemes, and they do exist in a lot of countries. Even with the freest of markets, there are those things. The UK now, that's what I was saying earlier about the UK, is actually bailing out small and medium businesses. There are strings attached, there always is. But the government's actually pushing a lot of that onto the banks. And the government, to an extent, is for the furloughed employees and what have you. That's government money, taxpayer money. So there's a couple of ways of doing it. It is a tricky one, but I think you've got to, again, it's a moral hazard question, isn't it? And you've got to strike a balance between those SMEs and newly formed businesses that had a really killer idea and it's going to really do well and it's innovative, right? And should you actually support them through a grant scheme or something with a payback period that might be on extended credit terms, something like that. Not a straight bailout. So if I think, my understanding, if the question is purely one of took billions into Virgin Australia because Branson, you know, although he's got he's only got a 20% shareholding in it now, but there's other big shareholders. What, so government to bail out an organisation like that? And the answer from the government of Australia was no, we're not bailing you out. It's your problem. They found a buyer. For the smaller startups, it's a much bigger challenge, but yeah, there can be support mechanisms. But look, you're never going to please everyone, but you shouldn't stifle innovation and entrepreneurship.
Would the small organizations have managed their risk? This is the question. Would they have done the necessary work to manage the risk for someone to say, look, manage your risk and we have to, yeah, it's a tough one for me. If we go back to the basis of risk, if you have planned for the worst case scenario, at least designed for that, and the context changes completely, you are selling oxygen and we're now breathing nitrogen. Should you get bailed out because we're now breathing nitrogen? I mean, it doesn't make sense to me. Had you looked at the whole, you know, business case or the whole business spectrum to understand what are your risks to the business, then where you can get some insurance. So this is why, you know, things like insurance, you know, you pay for it in advance, obviously, but that bridges your gap between your appetite and your risk capacity. We can't have people exceeding their risk capacity often, and you know, and you know, getting handouts. This is again my personal opinion.
Yeah, and I think you're spot on. I'll just like one other thing, I suppose, and it feeds on from your point, Sean, that if the organisations can show that they've actually done some really good planning, they've revamped things, they've looked at scenarios, they've gone through and modelled the balance sheet in different ways, and they've taken some steps. But a COVID-19's come along and they've said, but look, we've got contingency plans. This thing's just so big it's swamped us. It's just a series of crises and wicked problems and things. Then, yeah, maybe there's cases there again for some mechanism to support them for a period of time to help them get over that rough patch.
I mean, Rahat's just added a comment in the chat as well. You know, there is the other side of this situation where this is not just an ordinary event, and really nobody was prepared for this. So it might be a bit unfair to sort of hold people to to that bar. And also there's the other aspect which Rahat has brought up, is that it's not necessarily about rewarding the bad behavior of the company. You know, if the company fails, that has a lot of other effects on the employees, and in some cases, the whole environment surrounding that company, the people in that community. You know, I think there are other considerations as well that people who have much more stressful jobs than I do have to think about.
Let me chime in now. Okay. Yes, it's in a very extreme event, etc. If a bridge collapses because of a mega storm that occurred, you know, is there some form of lenience that occurs in the engineering company, or engineers have to design their businesses for the absolute worst case storm, the 1,000 or 100-year storm or whatever it is? You know, the thing that, you know, so they foolproof their design to last the test of time.
They do, I agree with you, but it's always to a point. So it's a question of where is that point?
But are businesses foolproofing their businesses, designing them in advance for the 100-year storm? COVID is not a 100-year storm here. COVID is literally a 5-year storm.
I agree with you. This is something we all, I think, should have been more prepared for.
Exactly. So what is the worst case? I mean, even we talk about the oil price. Oil price is not a 100 or 1,000-year storm. It's literally a 5-year storm. 2015, we were pretty much in this range. You know, 2012 again, or earlier, you know, things were tight as well. So how are we not foolproofing our businesses earlier? Are we not looking at these risks, or we've got short-term memories where, oh no, it can't happen, it happened before? Are we so comfortable that happened before? I like simple examples. You have an accident on a road, you become more careful. Yeah. You start putting on your seatbelt, etc. Do you then say, you know what, it happened 2 years ago, I'm not going to wear my seatbelt? Somehow we don't seem to learn. We don't seem to learn from past events and incorporate that into things going forward. That's my, the way I see things.
I think that's very fair. People have very short memories, especially when it comes to negative events. All right, well, it's gone past 9 o'clock, so I think we should wrap it up there. Thank you very much to both of you for giving your time and your experience, and for providing such stimulating discussion around this topic. And thank you to everyone who took the time to attend. We appreciate it, and we would certainly appreciate any feedback you have. Because we hope to do more of these events, and as always, we're trying to provide the best support that we can to the risk community in Qatar and in the Middle East. And finally, of course, a very big thank you to Hatem, who, without Hatem, really none of these events would ever happen. I won't say give him a round of applause, because that would be weird, because everybody's on mute. But I certainly appreciate the work that Hatem does, and I know all of you do as well. So again, thank you to everyone, and have a good evening.
Thanks, everyone. Take care. Stay safe.
Cheers, guys.